In this episode, industry veteran Mitzi Hutchens shares the hard-won strategies you need to succeed. She breaks down the fundamentals of fixed price versus cost-plus agreements, reveals the secret to earning and keeping builder trust, and pitches the one change she thinks the agencies should make to be 100% game changer for every construction lender.
Since COVID, I've seen a lot more cost plus contracts come into play versus fixed price contracts from what we all experienced. There is a way to still have a successful program and be able to support both fixed price contract and cost plus contracts. You've got to make sure you have that builder's risk policy in hand before any dirt starts to get turned on that property, before any improvements go underway, and so forth, just to make sure that that collateral is covered for all parties involved.
I'd like to welcome everybody to the Construction Lending Podcast. I'm your host, Sean Ferris, and today we have a very special guest, one of my favorite people out there. And if you've ever met me at a conference, I'm always singing her praises, and that's not because she was probably one of our first customers out there, but really easy to talk to and somebody that's helped me grow in the industry. So I'd like to introduce everybody to Mitzi Hutchens. Mitzi, welcome to the podcast again.
Thank you for having me.
You've really been inspirational to me, as I've grown in my own professional development.
Well, same here too. And it's a privilege just being able to do another podcast with you. So always enjoy it.
So what's going on with you? What's happening?
Well, I am still managing construction lending and renovation lending, enjoying it. As you know, this is my passion and has been for quite some time. I think going all the way back to 2010, 2013-ish. So still doing what I love.
Why don't you tell our listeners, what was the catalyst? What was the event for you and your introduction to construction lending?
Sure. So, okay, let's go way back a little bit. So back in 2008, I had joined, I believe the name at that time was Georgetown Mortgage. It changed from Georgetown Mortgage to Home Source to Thrive Mortgage, but I believe it was Georgetown Mortgage back in 2008. When joining Georgetown Mortgage, I had actually started as a loan officer and then became a processor and then processing manager and then a corporate trainer and so forth. So I've worn many, many hats over the many years. And whenever I was actually a corporate trainer, that kind of led me down the path of learning construction lending. We were bringing on a new branch out of San Antonio, Texas, and it was a pretty large branch, and majority of their lending supported construction loans. So at that time, it was two-time close. They were actually set up with a pretty sweet deal where there was a money company that did the funding of the interim construction. And then there was a sister company or affiliated company that had a lumber yard in San Antonio. And then there was the mortgage branch. And so you had the builders buying lumber packages, materials, and so forth from the lumber yard. And then you had the private money for the interim financing. And then you had the mortgage branch that was able to assist with the permanent and refinance transactions. So they did majority of two-time close back in the day. And so as a corporate trainer, I had actually went down to train and transition them to Georgetown Mortgage. They were becoming a branch of ours. And that is when the construction path took off. That's when I learned a lot more about construction lending. I always knew the two-time close, right? So like old school to all of us way back when was a bank did the interim financing, and then of course the mortgage typically did the perm refinance transaction. And so that's what started my journey off in construction. And then it just grew from there as far as the different then positions that I had taken on. But whenever I went down to train that branch in San Antonio, there was an unexpected departure with the branch manager that was there on the, boots on the ground. And so I jumped in and I asked for the opportunity to manage that branch since I'd already learned how, the process and the infrastructure behind construction lending there and what they were doing. So that's what we did. It was a deep dive into construction lending. We moved down to Boerne, Texas, and I became the branch manager in San Antonio.
Wow. So in the training process, you're a trainer and you go down there to train the branch. They already knew how to do construction loans down there, right? Like they had already been doing that, the synergy between the lumber company, and a lot of that's interesting. This is not the first time I've heard the theme where the corporate trainer learns construction and sticks with it. And cool career path in that direction. So you go down there and you're learning it, and you're learning their processes, and you're teaching them the processes of the company. And you're like, hey, I really love this construction lending side. The branch manager job opens up and you seize the moment.
I do. Yes.
And then how did it go from there?
It was great. There were some bumps in the road with the departure of the existing branch manager. We did lose some loan officers that followed her, which I completely understand. They had worked together for many, many, many years. And so we had to rebuild the branch. We rebuilt the branch where we had up to, I believe, 9 loan officers. I had 3 processors, admins there. And so we rebuilt the branch and supported quite a bit of volume. There was about 70 loans units out there in the process of trying to close, homes being completed, and so forth. So I rolled up my sleeves. I jumped in. We rebuilt the branch, had all the necessary people in the right seats on the bus, and it was great. It was exciting. A lot of learning during that time whenever I was acting as the trainer, but it was exciting times, especially whenever you were rebuilding the branch, bringing on other loan officers from other companies, supporting construction, just seeing, construction is a different animal, Sean, as we know, right?
Well, how do you rebuild a branch? Like, especially one that's focused that much on construction. It's not like you can go down to post an ad on Craigslist and say, hey, want to learn? Or
right.
How do you do that?
It is hard. It is hard taking a loan officer that does not have any experience with construction and having them jump in and support these type of loans. There was a couple of loan officers that joined our branch. And then there was a handful, of loan officers that did not have that background in construction lending. And so it was exciting to the fact that we trained. I was hands-on, looking at their loans, talking to builders, helping them grow that partnership in the region with referrals coming in the door and so forth. But there was a lot of hands-on, a lot of training that took place. But I will tell you, the moment that I had a loan officer that had that aha moment, I call it, right? That aha moment. I mean, it could take 6 months, Sean, but once they had that aha moment, like, oh my gosh, it clicked. I finally get it. It was the most rewarding thing knowing, sweet, okay, trained you up. Now you're good. Now you can, kind of go out there on your own, originate the loans, feel comfortable, take an application and so forth. But there was a time frame that you did have to train up to support construction. At that time, it was only 2-time close. So there was a time frame where you did have to train and, of course, be well involved and integrated in that process with the support giving to our sales teams, our loan officers, and our processors. But once someone had that aha moment, it was rewarding. It was awesome. And I still see those aha moments in people, from my time there to what I do now today. It takes a while. If there's not experience that they have with construction lending, it takes a while to really put the pieces together of that interim loan and that perm loan whenever you're supporting 2-time and having that aha moment, which can take a month. It can take 6 months, but it's rewarding once you get there.
Well, let's talk about the aha moment. Right?
Okay.
So what's involved in the aha moment? I'm reaching my 6 months and all of a sudden things start to click. Is it the loan structuring? Is it the relationship? It's like, oh, I now understand how a construction loan works. What is that about?
Yeah, so I would say there's a few different factors to it, right? So it's really about building partnerships with builders. I've always said that I love working with builders, and if a builder trusts you, then they're going to be very loyal to you. And if you really understand what you're doing, right, between making sure that you are being best in class, delivering the best service to everybody, builder, our customers, third-party vendors that we work with, once you build a great builder partnership, that's going to be one aspect of the aha moment, right, is you're really knowing that it's not just a one-off transaction. It is, you're out there, you're building a partnership with that builder, because that's going to be a long-lasting partnership that you have from here until whenever. So that is one thing, is really just making sure everyone understands the importance of not a one-off loan, right? You're building a partnership with that builder and making sure that you're going to take care of their customers. And what that means and looks like too is once you go to the closing transaction for the construction portion, you're not done, right? It's not a one and done. You're still having to communicate and follow up and check in on the build status. Even though you have a draw team and the servicing aspect then comes into play with the builder. But as a loan officer, you still have to communicate with that borrower. Check-ins monthly is my best practice, is check in, see how everyone's doing. And that's how you consistently stay in constant communication with your builders and your borrowers. And instead of thinking it's a one and a done, I closed and funded the loan and now I don't have to worry about it. I sit back until the refinance comes around. That's not the case. You still have to communicate, which goes back into taking care of our builders and our customers and providing that best-in-class service. So that's one aspect to it. The other aspect is understanding how the construction piece works as far as documentation, what you're looking for. It's not a purchase contract, it's a construction contract. Every builder seems to have a different contract. And so it's not going to be as like your normal purchase truck contract. It's going to be, hey, you have a construction contract. One might be 3 pages, one might be 10 pages. You're going to have your plan, your specs, your budget, your builder's risk. So really understanding and grasping what each document is another eye-opener, because if you don't have that experience in construction lending, someone might say, well, what is builder's risk, right? What is a cost budget? To really understand what that document is and how to read that documentation. Because again, as a loan officer, when you're supporting that builder in his partnership, you've got to be able to understand those documentation that you're getting and really read through the documentation. You have to understand the nuances of builder. Does he or she use a fixed price contract? Do they use a cost plus contract? What does that mean? And so that's another aha moment, is just the aspect of understanding documentation around the construction piece of it. And then your third aspect is really how to originate these loans. What information do I need to grab from all this documentation, and how do I set up an interim construction loan into your LOS system, and how do I set up that perm refinance loan into that system as well? So really understanding the communication, customer service piece of it, to documentation, building great partnerships with your builders, long-lasting partnerships, as I call them, and then the structural piece of it all really gets you to that aha moment. Now, there is going to be, even when you get to that aha moment, you're always learning something. I mean, I'm still learning something, and I have been supporting construction since 2010-ish. And so there's, it's ever changing, right? Just like the mortgage industry. But it's awesome. It's really awesome to see someone come to that aha moment when they look at you and they say, I get it. I finally get it. And I'm like, yay.
I got 3 big kind of buckets or categories to the aha moment. Is building builder trust, getting to that point where you understand it's about the journey and managing the expectations from beginning to end, building the trust and making sure they come back to you, right? That's number 1.
Yes.
The number 2 is around the documentation piece, knowing the plans, knowing the specs, knowing what all of them do and how everything works. And I think the third one is, you kind of hinted on, was the structuring piece. How do I know that this is going to work, right? How do I know that the loan amount's going to meet the construction contract and the reserves that they need and the permits they haven't paid for and the architect's reimbursement, how that credit works, and do they own their land? Do they not own their land? That big kind of, is this the right deal?
Right.
There's kind of a piece in there, and I just want to ask the question on this one is, I would think it is like a battle card or an objection response, right? So you mentioned, hey, they've got a cost plus contract. I understand the document. I understand what it is. Now, how do I work with and resolve this issue? We don't do cost plus. We only do fixed price, or identifying if the plans have been approved, have they been paid for, what stage are these really at? So how do you manage the issues that you encounter in the process? Right? That's a component of this, right?
Yes. Yep. Great questions. And there are a lot of moving parts. And so you've got to have certain procedures and processes in place, right, for management, just to make sure that you're reducing as much risk as you can, right, for both taking on that fiduciary responsibility of not only our organization, but our borrowers too. But let's say cost plus. Does our borrowers really understand what a cost plus contract is? And so cost plus contract is a little bit more riskier, as we all know, versus a fixed price contract. But I will tell you, since COVID, I've seen a lot more cost plus contracts come into play versus fixed price contracts from what we all experienced. However, is there a way to still reduce risk and manage it properly and still be able to move forward with a cost plus contract? Yes. What that looks like is you're going to have probably more requirements in place. You might require a 10 to 15% contingency automatic to be built into the budget. You might require reserves from your borrower, right? You might be looking at 6 months to 12 months reserves just to make sure that they have those assets needed in case the builder unfortunately underbids quite a bit, right? On a bid that's only guaranteed for 60 days, which goes back to being a cost plus contract. And so I feel that there is a way to still have a successful program and be able to support both fixed price contract and cost plus contracts. But it's going to all depend upon what you create as far as number one, how to reduce risk, and still while taking in consideration that we do have a fiduciary responsibility to both the organization and the borrower. So you just might have more overlays whenever you're working on a cost plus. And then two, I think it's very important, no matter if it's a fixed price or a cost plus contract, you're having those necessary calls with your builders. You're getting to know them. You're asking the right questions up front. Hey, how many times does the cost plus come into play where you're going back to your client and saying, hey, you owe me $50,000 at a later time? Just get to know your builder from the get-go and have those other necessary steps in place to protect all of you when using a different type of contract versus fixed price.
My brain's going a million miles an hour. Cost plus, guaranteed max price, fixed price. What's the right way to handle somebody when they come in the door with cost plus contract? Can you convert it to a guaranteed max price? Can you have that conversation of, hey, let's build that difference into a contingency? How do we manage change orders and those changes? How do we force the borrower to come in with the difference at each draw rather than at the end and everybody's surprised? How do you look at the reserves of the borrower? Hey, you guys got $1 million on deposit, at a bank somewhere. Wow, that makes me feel a little bit better about the situation versus, you're only putting 5% down and you're kind of meeting minimums. Probably not a good fit.
Yes, right. Yep, it's the entire picture. And there's a different way to skin it versus just one way, right? Not one way fits all. So those were great points that you mentioned. You just have to look at it and evaluate it and manage it completely different than when using a fixed price contract.
How do you say no? How do you know when this one, it's not quite passing the smell test? You kind of get that feeling in your gut, something's just not feeling good about this. How do you differentiate between those types of deals and the deals like, this makes sense. They do have $1 million. They have done this before. This builder has built homes, well reputable in the area. How do you manage those two types of situations?
Good question. So I have had to say no throughout many years of supporting construction, unfortunately, but I think it really goes back to, again, looking out for that borrower. The last thing that I would want to do is have a borrower that does not have enough reserves or any contingency built into a contract and knowing what risk could come into play during the build phase. And so in the event that, let's say it was a cost plus contract and they added, the 10% contingency, but then they didn't have any reserves, it's really going to be just reviewing that budget, looking first of all, how big of a home are you building? What is the framing package and concrete package and cabinetry package and so forth that's being allocated on that budget? Does it make sense? Is it in line or is it lowballed, right? And so really looking at all documentation from the whole picture. And if it doesn't make sense and if the necessary reserves are not there, if you have a borrower come in a closing and they only have 3 months reserves, knowing that they have to pay interest, right, during the build phase based off of what's being drawn, as well as typically they own another home or they're renting another home. And so that is when, if it is a hard no, because we don't want to put them into a position where something could go south and hurt their financial stability and situation, then we will say no. We will say no. Do we try to make every deal work? Yes. I wear the sales hat and the operations hat. And so I am risk adverse as well as supporting sales. And right now, every loan matters. We don't want to leave any loans behind that we can close.
I like
But
that one.
yes, but unfortunately, you can't always give a yes on every loan scenario. When deferring to construction, right? Deferring to the risk that go into play, and if the file does not meet the certain requirements that are put in for a reason, then it would be a hard no. Now, I will say that, Sean, too. Let's say that we were requiring 6 months reserves and they had 4 or 5 months of reserves. Then I would look at documentation a little bit more closely and have a bigger evaluation of the entire project versus just saying, nope, unfortunately, we cannot move forward. So there's a lot of moving parts that have to go into play. And it really comes down to managing it and just making sure that you're looking out for that borrower, that you're not putting them in a bad position.
You mentioned, reviewing the lumber package and reviewing the door and window package. How do you confirm those costs are realistic? They're going to come in on budget or near budget with cost plus, right?
Mm-hmm.
What are some of the things that you do to confirm that, hey, the lumber and truss package is what it is? How do you even know that?
Right. Good question. So typically on a normal standard construction loan, as a lender, in my experience supporting construction, I am not asking for those bids. I'm not asking for any type of material, lumber package bid, cabinetry, window package, and so forth. However, is it something that I would take that additional step and ask for in the event that we were trying to move forward with a file and the borrower did not meet required requirements, then yes, we would take any additional necessary steps where we could get comfortable with doing that loan. That is when I would ask for additional documentation. But on a typical standard loan, I do not ask for those type of bids. But again, too, kind of goes back to builder requirements. So everything kind of plays in line with one another, right? When it comes to managing risk and when to move forward and what documentation to look at and when you can turn a no into a yes and so forth. For like example, builder experience. In my time of supporting construction, we do have builder requirements. You might have a level 1 and level 2 or an elite builder. Level 1 might have 10 plus years experience, while level 2 might have 5 plus years experience. A level 1 might have 15 plus units built yearly, while a level 2 might have less than that. And then you have your elite builders, which is going to be your nationwide custom home builders, and those, of course, manufactured nationwide companies as well. But all of it ties in together, right? As far as what risk you're taking and what risk needs to be evaluated to make a determination as to what documentation is needed and how you're going to try to turn a no into a yes in the event that borrower does not meet a certain requirement. Does that I know I kind of threw out more as far as builder requirements, but it kind of
right on track.
Yep.
And I almost want to kind of recap this. And I even made a note down going, God, we really got to have a bigger webinar on cost plus contracts. But do you ever, right out of the box, would you say, the first go-to item is just simply to ask, hey, would you do a guaranteed max price or
yes
price? Like that should be standard operating procedure, right?
Yes, I agree. Yes. As a best practice, always see if you can have that builder get comfortable with doing a fixed price contract. If that means, hey, builder, you have a cost plus, depending on what contingency you built in already, can you get comfortable doing a fixed price and adding a higher contingency that will get you comfortable with it, getting a longer time frame on your bid as far as from those material companies and so forth. But yes, I think best practice most definitely is always ask the question. I know that whenever doing that initial upfront review, whenever you're reviewing that builder package, at that time, that's a number one question that I have is, do you use a cost plus or a fixed price contract? And that is when then the question would be asked, okay, if using a cost plus, if it's a lender that does not allow cost plus contracts to be used, then ask that question. Can you get comfortable doing a fixed price contract? And some builders can. Some builders say, you know what, I actually offer two, a cost plus and a fixed price. Fixed price is probably going to be usually higher. Right, exactly. Yes, surprise, I can do either or. But yes, I feel that a best practice most definitely always ask the question. Don't be scared to ask the question because you might get the end result that they offer both.
And then, let's say step 2 is, hey, it's not going to work. I got to go cost plus is, hey, what about guaranteed max price? It's kind of a hybrid between the two. We can build in a borrower contingency, not a builder contingency, but borrower contingency to cover that. But we need some sort of assurance that there's going to be a cap, right? Like that's probably a good, I would draw a little diagram saying, hey, if no, go to this spot. right?
Yes.
And see what can be accomplished there. And
Right.
then I've also heard, and maybe you can kind of confirm if what you like about this idea or what you don't like about this idea, is when,
Mhm.
hey, we've got lumber package, long lead time items, doors, windows, trusses, lumber package, whatever those things. And I gotta, the bid's only good for so long, and permits may take a little bit longer than, so you're kind
Mhm.
of pushing things out. What's your comfort level with, instead of builder deposits, giving a deposit to the builder, and I'm not talking about like the
Mhm.
upfront, but
Mhm.
advancing for the door and window package, trusses, those items, but directly to the supplier. So that way, if something happens with the builder, the borrower
Uh-huh.
still, it's still theirs, right?
Right, right. I'm glad you brought that up, Sean. What we have done in the past is, of course, the program supports paying everything off of completion, right? That's your typical standard. You pay your draws based off of completion. However, is there ever going to be a time where you can speed things up, or in the event that you're working with a cost plus and you have a shorter time frame window on those packages that are being ordered? In the event that we ever pay based off of an invoice after closing funding, we do require to pay the vendor direct. We do not pay the builder direct. We pay the vendor direct always, because that way we know that, hey, one, it's going directly to the vendor. They have the deposit that's needed, so then they can do whatever's necessary on their time to kind of speed along things. But we do offer that as a backup in the event that it's needed. We will consider doing it, but we do pay vendor direct versus paying the builder direct, which our builders are okay with that. I would think it's less accounting on their side anywho. And so the builders are okay with that. They're like, sure, pay the vendor direct. I just need to get the deposit paid in order to save time and the timeline process that it takes on that bid that's through a guaranteed date of X.
I love that. You see too many things go wrong. Hey, it's a 4-month lead time or 3-month lead time, and then some other dispute comes into play, and then it's like, well, that's my money. That's my money. You got to go get it back. It goes, builder can go cancel it versus, hey, it's name of the borrower. It's such a kind of a nuance to all this, and I love that you see it on that same page. Anything else that you see, a cool tip, trick, when it comes to managing cost plus contracts or steering people away from cost plus contracts? Any advice you'd give?
It's just really understanding the contract itself. As I mentioned, a lot of borrowers, they just don't understand what a cost plus contract is. And so really just understanding what could happen during the build phase, where a builder could come back and say, hey, I need you to give me an extra $20,000 because the water well install is going to be $20,000 more than what was budgeted for. So really just the educational piece, I feel, Sean, beside managing the risk aspect of it as a lender, but the educational piece of it is really for that borrower to really understand what that cost plus contract looks like, so then they can make a well-educated decision themselves to get comfortable with it, because they might come up and say, hey, I've only given you bank statements to support X, but I actually have 500,000, $500,000 over here sitting in another investment account of mine. So I'm good, which then we would ask for the documentation just to get comfortable with it. But I just think the educational piece, what is the difference of a fixed price versus a cost plus, is so important for everyone to be aware of.
We'll end on this. How do you tie in?
Mhm.
An important part of this is like, hey, at each draw, you want the whole balance of everything trued up. You went over, we need to true up at this point rather than getting to the end. Like, is there a difference between truing up at each draw and making sure that the balances are all paid forward at each draw, or waiting to the end and the borrower's got a big surprise? Like, how do you manage the surprise factor?
So we do not wait until the end to true up with any type of changes that are being made. So how we educate our borrowers and our builders from the initial stages, from pre-close and the initial call that we have with our builders whenever we're reviewing the builder package, is in the event that there is going to be a change order, one, we as the lender need to know about it when it's going to affect the budget. Now, in the event, let's say it's a upgrade for your front door, and the front door is a $1,500 and it's being upgraded to $2,500, that's a little bit different, right? But what I'm talking about is true budgeted line item change orders. We will look at those at each draw. So we do not wait to true up until the end. We want it active during the build phase at time of each draw, and we document it. And so in the past, there has been so many times where one of our customers, our borrowers, had worked with the builder and they had agreed verbally, oh yeah, you know what, let's go on and do this upgrade, borrower, you're going to owe me $10,000 later on, and so forth. And it caused issues. So that kind of goes back to making sure everybody understands the program, what you're looking for, and to make sure that we require the lender to be made aware of any change orders. So then we can process those change orders at that time of draw. If that builder and borrower come to us and say the builder needs to reduce this budgeted line item by $5,000 and move it to a different line item because of an increase or an upgrade, and it's still allocated for in the entire budget, then fine, but we're going to true up at that time, and we're going to require that documentation, give us a change order, and then of course everyone's going to execute and sign that change order as well as that draw and the updated budget. And so we do not wait until the end to make sure we're good and we true up later. We always make sure it's done during the build phase at each draw.
I absolutely love it. Absolutely love it. Now, I want to make sure that we get to this segment. I love the podcast, how it's turning out. We're a little off track from kind of where we normally kind of said, hey, let's do a podcast. Let's make it cover these subjects. But there was something so important that we've kind of hinted on, but it's like this art of saying no.
Mm-hmm.
And there's a lot of great advice out there about what you need to say no to, what you need to say yes to, but we really never focus on how to say no, why to say no. And sometimes in order to say yes, you got to say no. It's very important to do that. And I've seen people in this industry that love to say yes. Yes, we'll get you approved. Yeah, we'll make this work. Having the discipline of being able to say no is just equally as important. So whether it's that, hey, we're underwriting your loan and we got to deny you, right?
Mm-hmm.
Or we got to tell you, no, this change order can't be accepted. Mm-hmm. Or no, you can't get funds for work that's not done. Or no, you need to have builder's risk insurance. You can't skip that. How do you teach people? So we'll go back to your training days. How do you teach people how to say no?
I think it's having them understand the big picture, right, of the risk that's involved. Like builder's risk, right? Builder's risk policy. Again, it goes back to educating as well. If a builder was asking to be paid on his first draw based off of completion of work, and they do not have, they're working with their insurance company still on builder's risk, well, that's a huge no-no. But understanding the why behind it to teach your employees as to why we have to say no in that scenario is because, one, it's our collateral for the organization. It's the borrower's collateral. So we've got to protect our borrower. And so unfortunately, we've got to make sure, or not unfortunately, fortunately, we've got to make sure that we have the necessary documentation in hand, like builder's risk. You've got to make sure you have that builder's risk policy in hand before any dirt starts to get turned on that property, before any improvements go underway, and so forth, just to make sure that that collateral is covered for all parties involved. That's just one example. But it really, I think, goes back to making sure that they understand the why behind it and why it's necessary. Another example to bring up is a building permit. So I am a big supporter in having a building permit before you go to the closing funding table. Okay, so before that loan approval has been issued up front, you ask for a building permit. It's one of your conditions. Now, keep in mind, depending upon municipality and where you are and state level and so forth, if that borrower is not vested on that land, some municipalities will not issue a permit until that borrower is vested on land. So there's no way around it. You cannot get a building permit until after closing. And so that would be a different option. However, I would make sure that there has been a permit application filed with the county to make sure that got started, as well as documentation from the municipality regarding how long it's going to take to issue the permit. But if we're going back to building permit, the reason why it's so important there too is because if you have a one-time close conventional loan or FHA or VA being 12-month term, well, you know that you need to have that home completed within 11 to 11 and a half months at max, because there's certain third-party documentation and processing you have to do on the back end before you can convert it to that permanent stage. And so if you're in an area that it's going to take 6 months for a permit to be issued and you haven't done that necessary research and due diligence up front, and you don't have that building permit in hand, well, you've just blown through half of the term of the construction, right? And so we're automatically setting our borrowers and builders up for not having success of being able to meet that construction term within 12 months. So that's just another example as to why you have to say no sometimes. And it's for protection. It's for protection for all parties involved, and really explaining to the individual that has to say no the why behind it. I think it's so important to know the why behind it, because majority of the time, if you hear the why behind it, then it helps make sense more.
Very true. It reminds me kind of the early days of Land Grill, and we were doing a lot of statutory work.
Mm-hmm.
And oh yeah, as soon as I said statutory work,
Statutory.
it's like, the trauma starts to roll into your brain. And
Yes.
certain things. Hey, why do we have to have this notarized, or why is this document even needed? And we'd always have a joke around, we don't do these lien waivers around here. And how many times as a loan administrator you hear a builder saying, we don't do lien waivers, and it's like, what? And there was such a big difference, especially in our early days, of you have somebody with pretty decent, say 3 to 5 years experience, which I don't think is a whole lot of experience, but let's just say, hey, that's kind of a good baseline for experience. If they know how all the mechanics work, but they may not know how a dispersor's notice in Florida works, right? Or when the builder says, well, what is this thing? And you have to explain it to somebody. I think that's like once you have the reason why, the conversation is completely different.
Right. I agree. Yes. The why behind it says it all.
Yeah. Why do I have to provide this notice of commencement? Well, from a construction lender's perspective, one, it's borrower promise to do this in their loan agreement. Two, is that it helps provide the lender notice for everybody else downstream. So if you ever stopped paying your vendors, or there was an issue with people getting paid on that property, that they were going to notify us. And that's part of the mechanics here. That's how we get notification. Now, if you're able to explain that, builder kind of shakes and says, okay, I understand that. But if you turn around and say, well, I really don't know, or you give some BS answer, you're going to get into this is going to become a much bigger issue.
Yes.
So that why is very important. Very, very important. I like to think part of the superpower in this business is not just being able to identify people that can do the job, but to find the talent and the diamonds in the rough that know the answers to those questions and know the real reason why, and don't cop out because the title company says so.
Right.
Dagger in the chest. The title company said so, or it's part of their policies and procedures. Those are things.
Right.
Nobody ever wants
part
to
of
hear
our
that.
policy. No, you do not want to hear that, especially whenever you have that long-lasting partnership that you're building. So, but yeah, just providing additional information and providing the why behind it will get you ahead in the long run. So.
Oh no, this has been so great. I kind of like getting in the weeds in these in the podcast talking about some of this stuff. I think it's really important. And I always try to put myself in the position of like, what would I have loved to have learned 10 years ago, 20 years ago about how this is all supposed to work? And I think there's a big hunger out there for even experienced people of wanting to learn more. Hey, I'm going to pick up, even if it's one little tidbit, in this podcast, I'm going to pick up on that one little thing because there's no school to go to learn all of this.
Yes, it would have been great if there was some type of school to go to and sit at for a week or 2 weeks or 3 months or 6 months or a year. But there is nothing. Yes, there is nothing. You just kind of learn as you go, which, it's been fun.
If you could change one thing that's related to everything that we do here, what would it be?
Yep. One change that I would make when it comes to one-time close loans is being able to sell conventional FHA and VA loans to agency after closing and funding. If lenders had a securitizable option like you can on a USDA loan and only have the trailing document piece that comes over after completion, it would be amazing, especially for those lenders that are wanting to really start construction at either a credit union, a bank, or a mortgage, IMB world, wherever you are. If you had the option to sell these type of loans after closing and funding, it would help. And the reason that it would help is because your profitability comes into play, right? Especially if you're a newer lender getting into it. Your profitability would be better because of the margin that you would get immediately after closing funding versus having to wait until conversion modification, which takes place after the home is 100% complete and you obtain then all the necessary documentation you need to obtain before selling it to agency. It would help lenders if we had an option to securitize after closing and funding and to sell it to agency at that time versus waiting until modification.
Got to throw a follow-up. How much would it help?
Oh, goodness.
Because somebody at Fannie and Freddie are listening to this podcast. They got to be.
Right.
How much would it help? How much would that be a game changer? I think they need to hear this.
In my opinion, it would be huge. Now, of course, every lender still has to have the management aspect into play and the experience needed to support construction, but it would be huge as long as you're following the handbook and the guidelines, which we'll touch on another change here in a minute. But as long as you're following the handbook and the guidelines have been updated since starting out back in 2010, supporting programs, and then OTC back in 2013. But it doesn't take a lot. As long as you're following guidelines, you're obtaining the necessary documentation during the build phase. But if you had that opportunity to sell after closing and funding and securitize it, I think it would be 100% game changer, Sean. It would be. It would be huge.
It'd be huge.
Yeah. Now, I would say that, do I think 100% of the time it would be used? So let's say, for example, Fannie came out and said, hey, we're going to offer a securitizable option. However, Kitty is going to start as a normal standard conventional loan after closing, kind of like your USDA one-time close programs. You're going to have some borrowers that they do not want to go the securitizable route, or the lender doesn't want to go the securitizable route because then it might reduce the opportunity of home ownership with building a home, because a borrower might not be able to pay that pity while they're paying their other pity on another home during the build phase and so forth. But I don't know. I think that it would be 100% a game changer to allow lenders the opportunity to sell a loan after closing would be huge.
Confidence in rate is worth the pricing.
Oh, I didn't even bring that up. Definitely, Sean. My goodness, that was huge.
You get interest rate today. You get, and yeah, you may pay. I think you get a couple models where you see the overall payment difference, but in the long run, God, if your rate goes up 1/8 of a point, you're going to make that up pretty quickly. It's,
right. That's the most important.
Rate is great.
Yes, that is the most important thing. So lenders would not be risking offering a ceiling rate with a free float down at mod or a float down at modification. You're not betting against what's going to happen during the build phase. You're not having to hedge that rate during the build phase and so forth. So that's the biggest part of being able to have that option is to securitize it and sell it after closing, is because of that rate, right? The rate risk that comes into play with lenders offering construction is, I believe, the biggest risk associated with these type of programs, as long as you have the experience in knowing guidelines and so forth, just from what we experienced a few years ago with rate inflation. So yeah, that is the number one important option you would have if the agencies were able to allow you to sell it after closing and funding, is that rate risk.
Yeah, we can have a whole podcast just on that conversation.
Yes.
It's always a pleasure having you on the podcast. I think these are my favorite type of podcast because it's very conversational. We just, so everybody knows, we just kind of started in one direction and, we kind of filled in the blanks along the way. But Mitzi, thank you so much for being on the podcast. It's always a pleasure.
Thank you so much for having me, Sean. I appreciate it.
If anybody wants to get in touch with you, what's the best way for them to find you on LinkedIn or email? What's the best way for them to get in touch?
Of course. So my LinkedIn is always out there. Would love to hear from you. And then by email too. My personal email is mitzyhutchens@gmail.com. But always happy to help anyone out in the industry who has questions, who's wanting to dabble in construction or learn more about construction, the risk and the management piece and, the experience and the profitability and so forth. Always here, happy to help. So most definitely reach out to me. But LinkedIn will probably be the best way to get in touch with me.
Oh, fantastic. Well, thank you so much for being on the podcast, and we hope to have you on again soon.
Okay, awesome. Have a great day, Sean.
You too. Thanks, Mitzi.
Thank you.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.